You could have $500,000 saved for retirement and still make one withdrawal that costs you far more than expected, not because the money disappeared, but because of what that withdrawal can trigger. Most retirees think retirement taxes are simple. Take money out, pay the tax, and move on. But retirement income doesn't always work that way. The account you withdraw from, the amount you take, and even the timing can affect your taxes, Social Security, and Medicare costs. And there are 3 retirement tax traps you need to understand before making a large withdrawal. The first trap is Social Security. Many retirees assume their Social Security check is either taxable or not taxable, based simply on how much they receive. But other income can change the calculation. A large withdrawal from a traditional IRA or 401k can increase your combined income and potentially make a larger portion of your Social Security benefits taxable. So you might take out $20,000 for a home repair, medical bill, or major purchase, but the tax impact isn't necessarily limited to that $20,000. The withdrawal can change how much of your existing Social Security is included in taxable income. The second trap is Medicare. This one can be especially frustrating because the bill doesn't necessarily show up immediately. Medicare uses income information from your tax return to determine whether higher income beneficiaries have to pay additional premiums through IRMAA. And because Medicare generally looks back 2 years, a large retirement account withdrawal today could potentially affect your Medicare premiums later. In other words, the financial impact of one big withdrawal can continue long after you've already spent the money. Then comes the third trap, creating an income spike. Imagine you normally have a relatively modest taxable income, but suddenly you withdraw $80,000 from a traditional retirement account in 1 year. That extra income could push more of your dollars into higher tax brackets and potentially affect other income-based costs. The problem isn't necessarily that taking the money was wrong. The problem is taking too much from the wrong account at the wrong time. And this is where retirement income planning becomes different from simply saving for retirement. You don't just need to know how much money you have. You need to know how you're going to turn those assets into income. In the years after retirement, before Social Security or required withdrawals become a major part of your income, you may have an opportunity to control your taxable income more carefully. Depending on your situation, that could mean using cash or taxable investments, taking measured withdrawals from traditional retirement accounts, or considering Roth conversions during lower income years. The goal isn't to avoid taxes completely. That's usually not realistic. The goal is to avoid creating unnecessary tax spikes when you have more control over the timing. A carefully planned withdrawal today could look very different from the same withdrawal several years later, especially once Social Security, Medicare, and required distributions enter the picture. So, before you make a large retirement withdrawal, don't ask only, "Do I need the money?" Ask 3 more questions. How will this affect my taxable income? Could it change the taxability of my Social Security? And could it affect my future Medicare premiums? Once you start looking at retirement income as a sequence instead of a single number, the strategy becomes much clearer. Because retirement isn't just about building the biggest nest egg. It's about knowing how to use that nest egg without accidentally creating a bigger tax bill than necessary. Plan the withdrawal before you make the withdrawal. Check the numbers and consider speaking with a qualified tax or financial professional before making a major move. If you want more retirement tax strategies explained in simple terms, subscribe, and I'll see you in the next one.